broaden out our macro scope with Mr. Jens Nordvig joining us, founder and CEO at Exanta Data and co-founder and CEO at Market Reader. Jens, welcome back to the show. Let's start with the read on the market with a lot of economic data this week, the second half, but also big tech earnings. What's most important here? What moves the needle?
Well, clearly, as you've discussed over the last 10 minutes, semiconductors have been in focus, and I'm not going to ignore that. But I do think there are other things brewing in the background that's starting to get more attention and should be getting more attention, right? So there's a China concern coming into the market again, and we can see it in commodities. We can see it in copper really starting to break lower. Maybe what's going on in crude oil over the last couple of sessions is related to a China concern as well. It's a pretty broad-based doubt in commodity space that the growth is going to be there and be sufficient. So I think that's a theme that's relevant. I think it's also very interesting, right, that we have a situation where global interest rates might be peaking, right, but we still have U.S. policy rates at a multi-decade high, and at the same time, interest rates in China are breaking to absolute crisis levels, levels we've not seen only a couple of times over the last 30 years. So there's this massive divergence in the global economy, right? And we watched the little details of the US data, but looking around the world, there's some cracks that are worth paying attention to, I think.
I'm really glad you bring that up because as far as my China analysis goes, I kind of have like a set it and forget it approach. You know, I'm kind of thinking like big regimes, and the general way I've been thinking about is, okay, they've provided a little stimulus. It seems like they're done being so onerous on their own capital markets. Maybe things start to improve, but that was kind of like a 4 months ago description. Sounds like maybe you're arguing we should refresh that they're having some issues still.
I think in a way, with respect to China, it's kind of an issue of not overthinking it.
Okay.
It has had an incredible real estate bubble that developed over a long period of time. It's not something that's going to be sorted out in a couple of years, right? So we can have tactical moves in the market, right? There's a policy initiative that might impact what is happening. But the big picture is that the overhang, the oversupply of property in China is not a problem that's easy to solve, right? And you can see the lack of confidence in China spilling into all kinds of indicators. I think the most extreme is literally fertility. When you can see fertility collapsing in country, you know there's something very serious going on. And that's what we have seen in China, right? And now I think people are giving up hope on these kind of like mini tactical moves that boosted, copper for a couple of weeks, and we're turning around. And the big picture is that China's facing the biggest structural challenge that they've been facing in decades, and it's starting to impact some markets in a meaningful way.
Okay. Now, commodities softening up, then, is that the message that limits to China's potential and kind of the rest of the world are limiting the broad potential for growth? Because here we're starting to talk about cuts like in a negative way. Our economic data has been missing. Does all this kind of add up to general weakness, Jens? Because, boy, a lot of folks are arguing that, like, we're coming out of the downslope of a cycle. And it seems like that might be contrary to what I'm hearing here a little bit.
Yeah, I think that the China effect is pretty structural. It's going to be with us for a while, right? And then we have a lot of hope that we can have Fed easing, potentially sort of reinvigorate the economy. I think the question is, what kind of lags do we have in monetary policy, right? There's still a lot of people who are locked into very low mortgage rates, and any kind of resets there will be for higher rates, even if the Fed cut a little bit. So I think the interest rate sensitivity is tricky because we haven't really felt all the effects of past tightening. So lots of movements in the market. We also have, as I think you alluded to in the earlier segment, right, a lot of confusion about, okay, which direction is the Trump trade actually going, right? So there was a couple of weeks where people were gearing up for trades that were sort of expressions of Trump having a high probability of winning. But now we have a different dynamic. There's been some polls coming out today where Harris is doing better, right? We've seen the numbers in terms of the fundraising on the Harris side that have been pretty impressive, right? So there's certainly a shift in momentum, right? So that sort of steady increase in the Trump probability that was behind those trades is in question now. And I think that means that a number of these themes are going to be tested, especially if you start to see the polling picture shift in a more convincing way. And certainly there's a chance to see that around the Democratic Party's convention.
What is your assessment of the veracity of some of that analysis to begin with, kind of the base level ties between a Trump trade and, say, Bitcoin, a Trump trade and small cap outperformance, Trump trade, dollar down? Like, is that the way you see it? That's what folks are arguing. It does seem like there are a few things. There's a lot in there. I feel like one could argue, like, Bitcoin's done great under every administration, basically.
Yeah, well, so I'm advising institutional investors around the world within ex-ante data, right? And we're certainly getting a lot of questions around dollar policy. Is there a big shift in dollar policy? I actually wrote a Substack about it that I'll tweet out after this. So that's a big theme that big investors are thinking about. I think when you look at the small cap move we've had, that has been extreme and supported by very extreme flows. I think one question mark I have is this notion that, okay, is any kind of interest rate cuts really going to be that dominant a force, right? They would likely come in the face of fairly weak growth. And I think it's also worth keeping in mind, right, that as opposed to previous cutting cycles from the Fed, we've typically had no inflation issue. And as soon as growth was weak, the Fed cut aggressively. This time around, the Fed is going to have inflation concerns in the back of their head, and it's going to be much more cautious cutting, and therefore getting that big impulse from rates, I think, is much more questionable on this occasion here.
Okay. Dollar, it sounds like, is going to be really the epicenter of a lot of our macro analysis, generally speaking, which is kind of amazing because the basket has basically, been very stable over the last 5 years. There were some ups and downs, some pretty big ones, but ultimately, dollar's pretty much held in there through a lot of different regimes we've gone through. So it seems like it would take something really profound like we haven't seen. I mean, last Trump admin, dollar was basically flat.
Yeah, well, so I think the concern that I'm hearing from institutional investors around the world, right, is that we're going to have a more dramatic shift in dollar policy. So we've implicitly had a kind of strong dollar policy since the mid-90s back to Robert Rubin. And now we have a situation where more and more people in the Trump orbit are talking about a more active policy to weaken the dollar. So I think that's the sort of regime shift and something indeed dramatic that is on everybody's radar. The question is, what specifically is that policy? Is there some action to actually back up the words, right? Because as we've seen around the world, Japan recently, right, just using words is generally not enough to move the currency around.
Well, it also seems like the natural forces that would make the dollar go down are not particularly desirable. I mean, the dollar's big run the last 5 years came as we led the way out of COVID, an excellent thing for us as American investors. It's like if there's an artificial policy to bring the dollar down, if you just start cutting rates like for no reason, like that's kind of insane, is it not?
Yeah, so one of the ways you can think about bringing the dollar down, depreciate the dollar, is to have some kind of influence on the Fed, right, and maybe cut rates prematurely, and that obviously would be causing all kinds of inflationary issues. So I do think policymakers are extremely aware of those issues, right, because we've experienced painful inflation very recently. So I don't think there's any illusion that inflation is something that is bad and unpopular amongst voters. So there's really no free lunches here, right? But I think there is a focus on manufacturing. Like there's a focus on kind of reviving manufacturing. So it seems a bit old-fashioned, but that is a part of the Trump administration, future potential administration's rhetoric, that they want to boost that sector specifically. And obviously a weaker dollar is something that in itself will help. But the problem is, as you say, getting that dollar down without having negative side effects is a very, very challenging thing, being it tariffs, being it like taxes on capital flows, all those kind of things have very, very serious negative side effects. So the question is, do you really want the weak dollar? And then obviously good why we've had a policy in the other direction for a couple of decades by now.
Yeah, purposely hitting the dollar just feels to me like a kamikaze run with hard to imagine like what is particularly great about it, but you know, who knows. Jens, great to have you back on. Great chat.
Okay, thank you very much.
Great context for us, great international perspective. Jens Nordvig, co-founder of Market Reader and Exanta Data.